Susan Collins is one of the most powerful people in America. The president of the Federal Reserve Bank of Boston, the first woman of color to hold that position, belongs to a select committee in Washington, D.C. that decides whether interest rates should go up, down, or stay the same. We had an exclusive peek into how she makes decisions that influence what you pay to borrow money for a home, car, or what a bank pays you to open a savings account. The Fed has held rates at a 23-year high in the range of 5.25% to 5.5% for nearly a year as it tries to tame inflation. And right now, Collins and her colleagues at the Fed are wrestling with a vexing question. Has inflation cooled enough from its pandemic highs to start cutting rates?
We're going to have to let the data really tell us when it's clear that we're sustainably on a path. And that means looking at a wide range of data.
In June, the Federal Reserve opted to hold interest rates steady in the battle to bring down inflation. It signaled just one interest rate cut this year. Part of the decision for setting interest rates is from information gleaned by regional Fed Bank presidents on the ground in towns and cities across their districts, like this one in the 1st District, which spans 6 states from Maine to Connecticut. Collins monitors key data from the Personal Consumption Expenditures Index to the monthly jobs report for clues on the direction of inflation and the economy. But it's also important for her to talk to local businesses, banks, and consumers to see if the official data line up with what she's hearing on the ground.
A lot of the data is telling us what happened last month or last quarter. And when we talk to people, they're telling us what they're seeing right now. They're telling us about their plans and how they see things evolving. And so that's one thing that's important. It also helps to kind of flesh out what the data are telling.
We were invited to follow Collins around for the day in Lawrence, Massachusetts, a former textile town 28 miles north of Boston that's seeing a renaissance. Collins started her day hearing from a local group of bankers and real estate developers who discussed how investments made in refurbishing low-income neighborhoods have fueled the local economy's redevelopment over the past 10 years.
Why don't we start with introductions? Let's go around the table.
She went on to hear about the impact inflation is having on local businesses and the desire for lower rates.
The cost of living is getting out of control. And the rent is something, let me tell you, extremely out of control. Extremely out of control.
One of my key takeaways was really understanding some of the challenges that the higher inflation that we had endured is creating, especially for smaller businesses. And the fact that labor markets are actually improving. It's getting easier for people to hire, and there's much less turnover.
Despite the Fed's dual mandate of promoting maximum employment and stable prices, inflation has been the greater focus for the Fed as it's opted to hold interest rates steady while other central banks have started cutting rates. After a scare earlier this year that inflation may be stalling or reaccelerating in the first quarter, the latest readings confirm prices aren't accelerating but may be moving down slower than thought.
It's inflation. We're all consumers at the end of the day. We all buy food at the end of the day. And our biggest challenge over the past 3 years has been, how do we provide a high quality product at a price that people are willing to pay?
The data suggests an economy with demand and supply coming into better balance, which is what's required in order to restore price stability. But this process may just take more time than previously thought. It's too soon to tell whether inflation is durably on a path back to 2%.
What Collins and her colleagues watch closely is the Fed's preferred inflation gauge, the so-called Core Personal Consumption Expenditures Index. It showed inflation grew at 2.8% year over year as of April, a level unchanged from March. Another measure of inflation, the more popularly cited Consumer Price Index on a core basis, rose 3.4% in May, cooling from the 3.6% increase seen in April and 3.8% in March. Both are still above the Fed's 2% target. Jonathan Isaacson is CEO of Gemline, a business based in Lawrence which prints custom logos for companies on a variety of swag, from bags to hats and even coolers. Gemline is one of the largest employers in the city, and Isaacson says he hasn't been able to push through price increases to customers.
The time of being able to just hand off price changes is now over from our perspective. During COVID, we did pass through a number of price changes and everybody understood it. Today, things seem to have normalized and people just aren't accepting it anymore.
For economists, that's one of the first indicators that inflation is likely to gradually come down.
I think the data that we have seen recently in terms of CPI, in terms of the producer prices, is consistent with an economy that in an orderly way is becoming better aligned. But we also first quarter saw news that was more disappointing, and the inflation numbers in particular, but other data as well, those monthly numbers are really volatile. The volatility is still quite elevated. And so I do think we have to be patient.
Collins and her Fed colleagues don't expect to lower rates until they gain greater confidence that inflation is moving sustainably toward their 2% target.
Is September too premature to think about cutting rates? Are we looking at something later in the year, more like November, December?
I think we're going to have to let the data tell us. So it seems to me that there are very plausible scenarios where we, later in the year, it would be appropriate if we see strong, continued good news on inflation and an economy that is aligning.
Are you looking at 1 or 2 rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both. I mean, I think that as I look forward, my view of how much easing might be appropriate this year has been reduced as I looked at the data.
Collins is also watching for any signs of a slowing economy, which would help the argument for lower rates. The official data indicate the economy may be cooling. Growth in the first quarter slowed to 1.3% from 3.4%. But on the ground in Lawrence, Julie Thurlow, CEO of Reading Cooperative Bank and chair of the American Bankers Association, says the economy looks resilient based on demand for loans outside of housing.
I'm optimistic that a soft landing is in our future. We still see demand. Consumers are still spending. Interest rates are high, but I think it's more of a structural problem that we have as far as housing is concerned.
Collins says she sees a solid economy overall that's showing healthy signs of cooling.
What I see in the statistical data is certainly evidence that the economy is coming into better balance. There's been some slowing in demand, but an economy that's still solid. But it's still quite mixed. There are differences across sectors, there are differences across regions. And what I heard today, it's very consistent with that in the sense of some firms that are still seeing quite strong demand and others where they're seeing consumers being a bit more cautious in terms of their spending.
What's the risk that in the quest to gain confidence that inflation is dropping sustainably back to 2%, that you hold rates at current levels so long that you sow the seeds of a recession?
So the risks are absolutely two-sided, and both sides of our mandate are top of mind for me. So I do think that there is a risk that if we held too long, we would see more slowdown than we need. And that's something that I watch carefully. I think that labor markets are still strong. I think they are not overheated the way that I would have described them earlier, but continuing to watch what's happened across a range of indicators in that space is also important in terms of the timing that will be appropriate to change the stance.
So the soft landing still in place?
Well, I continue to be that realistic optimistic that we're going to bring that inflation down, but we're going to do it amid a labor market that stays quite healthy. And, lots of uncertainty around that, but I still see that possibility as being very much the path that I believe and hope we're on.